Your bank can freeze your business funds today, and payroll, vendors, ads, and tax deposits can fail tomorrow, unexpectedly fast. This hits you, your company, and your family when one restriction triggers late fees, defaults, chargebacks, and reputational damage quickly. It happens because KYC and AML monitoring scores patterns, identity consistency, ownership clarity, and documentation quality across multiple systems today. In this video, you will learn evidence readiness, freeze triggers, treasury segmentation, incident response, and a practical audit routine today. Most freezes start as internal risk decisions, not court orders, because providers must protect licenses under tightening regulations now globally. Detection is faster now because monitoring is automated, data is matched, and uncertainty is escalated before humans review context properly. Cross-border profiles face more friction because travel, address changes, new countries, and volume spikes look riskier to algorithms and scoring. When restrictions hit, time becomes your enemy because wires stop, ACH blocks, settlements hold, and accounts can terminate abruptly suddenly. If you rely on one bank and one processor, a freeze becomes existential for revenue, payroll, vendors, and delivery timelines. If you build redundancy and segmented liquidity, the same freeze becomes a manageable incident while operations continue during reviews smoothly. Treat banking access as infrastructure, not a single account, and treat documentation as an operational asset maintained continuously everywhere today. Have you tested survival if your primary provider pauses outgoing payments for 7 days during peak obligations and shipping season? Identity inconsistency triggers holds because mismatched addresses, phones, residency narratives, and device behavior create compliance gaps across providers today everywhere. Ownership uncertainty triggers holds because stale onboarding, unclear beneficial owners, or layered structures without purpose suggest hidden control risks today. Weak source of funds support triggers holds when large inflows lack contracts, invoices, delivery proof, and customer context for analysts right now. Corridor changes trigger reviews because new countries, new vendors, and new banks activate sanctions checks. AML alerts immediately too. Transaction behavior triggers alerts because rapid in and out movement and round numbers resemble laundering when memos lack business purpose clearly stated. Disputes and chargebacks trigger reserves because processors predict reversals, and slow replies with incomplete evidence extend restrictions longer for months. Commingling makes everything worse because personal and business flows destroy narrative clarity, complicate accounting, and trigger deeper questioning during reviews. Industry policy risk matters because some legal models are labeled higher risk, requiring tighter controls, proof, predictable behavior, and files on. Weak bookkeeping cadence is a hidden trigger because unreconciled deposits and missing invoice matching look unexplained to monitoring systems fast. Concentration risk multiplies damage because one institution controlling liquidity causes missed obligations, vendor panic, and broken customer trust within days. A service LLC receives large international wires labeled services, then moves funds outward quickly, resembling layering without contracts attached today. An e-commerce seller scales rapidly, payout volume spikes, refund ratios shift, and loss models hold settlements and expand reserves overnight. A founder changes countries and devices weekly, creating shifting identity signals that trigger enhanced verification despite compliant reporting for providers. A business onboards as consulting, but runs marketplaces or subscriptions, creating category mismatches that trigger reviews during growth spurts suddenly. Revenue does not reconcile to deposits because fees, refunds, and timing differ, so analysts cannot close the file quickly internally. A legitimate launch enters a new market without updating expected activity, and monitoring treats normal scaling as abnormal behavior again. A round-numbered transfer series hits your account, and compliance asks for invoices, contracts, and counterparties before releasing rails right away. A new supplier in a higher-risk country appears, and sanction screening triggers delays until ownership and end use are documented clearly. To avoid freezes, make your profile boring by standardizing identity data and matching narratives to statements and invoices at all. Keep beneficial ownership records current because outdated controllers and missing charts trigger escalation and extended review timelines in every file. Keep bookkeeping current and reconciled monthly because fast matching proves legitimacy and shortens restriction durations dramatically for every provider request. Document source of funds for major inflows in advance, because evidence speed is leveraged during compliance reviews when questions hit. Use consistent payment descriptors because vague memos slow analysis and increase requests for clarification from compliance teams across all rails. Maintain counterparty files with names, addresses, ownership, and purpose, because missing data triggers enhanced due diligence reviews when audits start. Update expected activity before launches in new markets, because surprises create flags while plan changes reduce escalations before money moves. Reduce concentration risk with segmentation and redundancy, because single points of failure turn restrictions into shutdowns quickly under real pressure. Segment cash into operating funds, tax reserves, emergency liquidity, and long-term reserves governed by a slower policy for your business. Segmentation protects continuity because a hold in one bucket does not freeze every purpose and critical payment during any review. Segmentation improves your compliance story because stable patterns make transactions easier to explain and verify quickly for analysts under deadlines. Choose one backup bank and one backup payout rail, then test them monthly with real settlements and exports without excuses. Redundancy is not random accounts, but regulated providers with documented use cases, limits, statements, and workflows that you can access. Use fintech as portability, not a shield, because fintech enforces KYC and can impose holds too under changing policies anyway. If you use digital assets, treat them conservatively, document conversions, and remember on-ramps can restrict accounts during regional outages globally. Track refunds, disputes, and chargebacks weekly because sudden metric shifts trigger reserves, holds, and risk downgrades before problems escalate quickly. Build an evidence pack ready within an hour, including formation papers, EIN proof, ownership charts, and contracts in one folder. Include invoices, delivery proof, flow of funds mapping, and descriptors aligning with your website and customer communications in plain English for reviewers. Export statements and transaction reports routinely because some providers remove access after closure, blocking later reconciliation from day one later. Use dedicated business accounts only because personal transfers into business rails create confusion for compliance and accounting in one narrative. Keep IDs and corporate documents updated because expired passports and old addresses can trigger re-verification checks across every institution today. Create a first-hour incident playbook with contacts, evidence order, payment priorities, and transfer pause rules before a hold ever happens. Your playbook should include payroll coverage, vendor messaging, and escalation steps to maintain credibility during reviews when access disappears internally. When stressed, avoid angry emails, because emotional narratives slow resolution while structured documents accelerate compliance decisions to reduce escalations dramatically. Your goal is to shorten the evidence cycle and restore rails with clarity, not to argue ever under pressure today. Diagnose by mapping every place you hold, receive, and send money, including banks, processors, marketplaces, and wallets worldwide right now. List must-pay obligations for the next 60 days, then compare them to accessible liquidity if your primary rail freezes today. Measure settlement timing for each provider because payout delays determine how long you can operate without incoming cash in practice. Decide minimum balances for operating cash, tax reserves, emergency liquidity, and long-term reserves based on volatility and risk every quarter. Decide which corridors and counterparties are mission-critical, then document them with contracts, invoices, and delivery proof for quick verification later. Execute by testing backups end-to-end with real payments, then exporting statements and reconciling results in your books at least monthly. Execute by standardizing identity data across providers, including addresses, phones, business descriptions, and ownership disclosures consistently for fewer mismatches later. Execute by slowing unexplained pass-through transfers, because speed without documentation looks suspicious to automated monitoring tools during peak volume periods. During a freeze, prioritize payroll and core vendors, and pause non-essential transfers that could create flags within your first hour. Send your evidence pack first because complete documents shorten analyst work and reduce follow-up questions substantially before you send explanations. Ask support for exact missing items because guessing wastes time and can contradict onboarding narratives already on file in writing. Keep communications factual and concise because compliance teams respond to clarity, timelines, and document links, not emotion, every time today. If a provider requests source of funds, tie each deposit to invoices, customers, and bank statements with timestamps with clear PDF evidence. If a provider requests ownership proof, provide updated charts, IDs, operating agreements, and governance notes showing control clearly for reviewers. If a processor expands reserves, improve fulfillment proof, refund handling, and customer communications to stabilize risk metrics over time consistently. If chargebacks rise, fix product expectations and dispute workflows quickly, because delays increase holds and reserve levels immediately for cash flow. If you operate cross-border, keep travel and address changes documented, because shifting signals trigger re-verification frequently in one shared folder. Consider professional help for complex structures, because incorrect ownership or tax classification can worsen compliance and banking outcomes when necessary. Your business survives freezes by being boring, documented, segmented, and redundant, not by being clever or secretive in public today. Ask yourself, could you operate 30 days if deposits continue but outgoing rails pause and bills still arrive right now? Recap. Know your triggers, keep identity consistent, update ownership, document inflows, reconcile monthly, segment cash, test backups for every provider. Recap. Maintain an evidence pack, track disputes weekly, align descriptors to contracts, and keep incident playbooks current during fast growth. Subscribe, like, share, and comment your country, business model, and payment rails, so future episodes target your situation below now. This content is education only, not legal, tax, banking, or compliance advice. Rules vary, so consult professionals as needed always. If you want more deep dives, suggest your platform stack, and we will analyze common freeze patterns in future videos.